Delano, it's great to have you with us. Happy Friday. Key, of course, going into this earnings season, it's all about the expectations, the guidance. We have seen a bunch of cuts, whether that be price targets, guidance estimates, over the last week or so. Has it been enough? What do you think? What are you expecting for this earnings season?
Thanks for having me, guys. You're right. I think we have seen some cuts, but I think estimates are still high. So for Q2, you're still looking at estimated earning growth on the S&P 500 about 4.3%. And if we actually hit that growth rate for this quarter, it would be, obviously a lower that we've seen since Q4 of 2020, which was at 4%. So I still think we're a little bit high. You guys are just discussing, how the consumer is doing, which I think we're teetering, right? Like there are places where we're seeing the consumer, spending on their savings. You're seeing the banks set aside money for provisions for a bad credit, and that's a real thing here as we look to what tech companies are doing. If you actually look at how the tech companies are actually cutting jobs and maybe freezing or laying off, there's giving signs that things are slowing down. I think that has to be taken into consideration.
Yeah, and Delano, it's been kind of interesting the way that Wall Street analysts have been cutting. It's been sort of top down in batches, a whole bunch of names thrown in instead of on an individual stock basis. So do you think that could lead to some good bargain picking opportunities in the weeks ahead?
Yes, Dee. I always look at, bargain picking opportunities, and that's, something that all investors should be assessing. I think that's a thing that we have to be patient here because, we've talked about what the Fed's going to do. We have that meeting coming up in a couple of weeks. And, with the inflation numbers that just came out, it seems like the Fed is going to still be aggressively raising rates, at least in the near term, right? And the market's pricing whether it's going to be 75 basis points or 100 bips, and that's going to be seen in a couple of weeks. But, for growth, that doesn't bode well for growth in the near term. And so investors that are looking for these bargain opportunities have to understand that we're still going to be in volatile times for growth, for tech, for that landscape overall. But I think if you look further out, there's going to be opportunities where these companies will reprice later on.
Dono, what do you make of Pinterest and particularly Elliott getting in? I mean, is this just a swift kick in the pants where you're going to expect management to perhaps be more on their toes now, to be more communicative, maybe crisper in their execution, and so that might get an investor more interested in being in it as opposed to a company where, hey, maybe it's controlled, maybe the CEO feels like he can take a long view and take his time figuring out the business model, or does it not shift your view on Pinterest versus its cohort in social media and advertising at all?
John, yes, I think it does. It is a swift kick in the pants. Whenever you're seeing the companies bring out, kind of outside consultation, obviously this is an investment situation. If you look at Peloton, there was outside consultation to restructure their business and their cost efficiency. That is a swift kick in the pants. I think investors are cheering the fact that their management has, been struggling. Obviously, the macro environment overall, but management in general has been struggling in an environment with Pinterest. So bringing in an investor, activist investor that can kind of look at it from a fresh perspective, that could be good. I think the business model is still strong. I've held positions in Pinterest, and I think there's still opportunity for it. But this macro environment bodes well where you have to see a fresh perspective, especially if management's struggling in a certain situation, John.